Hi everyone, my name is Darryl Panes, CEO of As Good as Gold Australia. And this evening, once again, I'm joined by my brother Brian,
Thank you, Darryl.
partner at As Good as Gold. And tonight we interview Alasdair Macleod. Alastair has been working in the financial world since 1970. I've been a member of the London Stock Exchange for nearly 5 decades. His experience encompasses commodities, gold, silver, equity and bond markets, fund management, corporate finance and investment strategy. Alastair is head of research for GoldMoney and is a very strong advocate for sound money. He's regularly interviewed at King World News, as well as many other premier networks such as CNBC. And we're proud to announce that Alastair has just recently taken on a role as advisor to As Good as Gold Australia. Good evening, Alastair.
Good evening, or it's good morning here, but it's nice to finally meet you over the ether.
Yeah, for us it's good evening and about 8 p.m. in the evening. So there you go.
Yeah, we've had some complications before when we've had interviews at about 5 to 12 and the introduction may go a little longer than we thought, and so we go from evening to morning in the same space. But Alastair, because we've never interviewed you before, and you've been working in the financial world for some time. People ask us, how do we get involved in precious metals? Well,
it's a long journey. A weekend description. 2 days.
For us, it was manufacturing for 30 years before we entered into the gold silver space. But you've been involved in the financial world for a long time. And I am sure our viewing audience would love to hear how it all started for you, what enticed you to start in this industry, and where it's taken you to right now. So if you could give us a snapshot of that would be fantastic.
I think one thing I would say is that to Australians of a certain age, you'll know the meaning of wild colonial boy, because I was actually born in Kenya in East Africa, and the sort of the pioneering spirit. Well, it wasn't pioneering; it was a generation or two after the original pioneers. There was that spirit, if you like, of enterprise, of beating the odds when it comes to farming in particular. We had all the things thrown at us, and I think Australians will resonate with that. So, I've got that in common with you. But when it came to finance, I'm sort of rather reminded of the comment about some bank robber in America who was asked, "Why do you rob banks?" "Well, that's where the money is," he said. And I was the same. I was just a sort of, I was salmon fishing in Scotland and thought, well, this is a lovely existence, but at the time I was aged about 20 or something, I really needed to go and do something. I always come back and do salmon fishing. And so it was the city that drew me, and I got an introduction into stockbroking. I intended to move on into property development and so on, but I stuck with stockbroking. And I very rapidly learned that there was a growing sort of cadre of economists who looked at life very, very differently from me. And they were effectively what I would now call the inflationists. We're obviously talking about the Keynesians and the neo-Keynesians. But the whole macroeconomic sort of scene is really driven by the sort of economics where, the economist is up here somewhere and we little people are down here. And that to me was, it divorced, if you like, my background from, the reality as I saw it. Interestingly, the 1970s was the era of monetary inflation following the collapse of the London gold pool. And of course, at the time, you don't necessarily understand all these things, but the collapse of the London gold pool in the late 60s led to Nixon ending the Bretton Woods Agreement in August 1971. By then, the price of gold was already you could see it was pushing up, and they'd refixed it from 35 up in a few steps up to 42.22. That didn't help. When they came off Bretton Woods, and that was very interesting because it was at the same time, particularly just a year or two later, we started having jumps in the oil price. I mean, we remember Sheikh Yamani, who only died, I think, a few months ago. He basically ruled the world. I mean, he was always on our television sets. And so there was this link between the price of energy and the price of gold. And there was no doubt from the Arabians' point of view. I mean, they understood that there were only two assets to have. One was property, which I suppose was an advance on Bedouin tents in the desert. They bought up half, the south of Spain and places like that. And the other thing, of course, was gold. And every time the US Treasury decided, well, we'll dampen down the price, and this is a thing that resonates today, they would have an auction of, say, 300,000 ounces. And it would just go like that. And the price would continue to rise. And so, the philosophy that you develop as an innocent stockbroker, if there is such a thing, it sort of was against that background. And I began to understand the difference between unsound money and sound money. Sound money basically being gold, and by extension, the other metals. The whole thing about going into the securities industry is that you continue to learn. I mean, if you don't, well, I suppose you might still survive. You might make a lot more money if you don't learn. But certainly, from my point of view, it was a learning process the whole way through. So I had about 50 years of deliberate learning, things that I would never ever understand. When I studied economics in a bit more detail, it became clear to me that the one school that actually understood what I understood from my background as a wild colonial boy was Austrian economics, the economics of money, the economics where people go out and do their thing. They are free to do it. They go out and they make money or they lose it. That's up to them. They employ people in that process, and people have the choice either to work for you or not. Government intervention is kept down to a minimal point. And we can define that even now. I mean, in economic terms, free markets really lead us to the thought that the only thing government should really do is defend the nation and ensure that law is clear and simple and enforceable. And that's it. They don't really need to do anything more than that. No. Now, that's not the realism we're living with today. Today is that, as nations, politicians, you could say it's the fault of democracy, have had to respond, if you like, to their electoral demands. You've had socialists who, if you don't as a politician respond to it, there's always a socialist who will promise something out of nothing, who will accuse the rich of being evil, and therefore you as a poor individual are entitled to some of their wealth, so we will redistribute their wealth. And the result is that government spending just goes up and up and up and up and up, and there's no control over it. And before very long, the whole concept of free markets gets buried completely. In the political debate. So, and again, going back to the 70s, I mean, I remember being in Glasgow, where I was a student, and I found that, for a start, nobody spoke like I did. I mean, I'm a Scot, obviously. Nobody spoke like I did, and this was a bit tedious, actually, after a while. I felt, let's say, a sort of a cultural mismatch. But also, I mean, the Scots were highly socialistic. I mean, I don't think they were socialistic by inclination, but politically, if you sort of got the view out that you were a conservative, I mean, you were basically ostracized. You were thought to be a freak. I mean, it was like that, and actually it still is. Which, well, I won't be drawn into more commentary about Scottish politics, but essentially, you had this sort of very parochial socialist system, and it involves union leaders. And the thing that's interesting, an Australian friend of mine a long time ago gave me an interesting insight on socialism, and it was completely as a result of a different conversation. I asked this chap; he was a fellow, I can't remember his name, but he was a fellow who was representing an Australian car parking business. And basically, what they would do, if you're building a building, this company would take out a contract to manage all the car park, managing the pricing and all that sort of stuff. And because this meant he was dealing with local authorities all the time up and down the country. And I asked him a simple question. I said, who are the easiest people to bribe? And he said, the further left they are, the easier they are to bribe. And I thought, now, I won't make a comment about how he did his business in the UK. I would say that was how business was very often done in the UK, a lot more so on the continent. I mean, in Paris, you couldn't do anything without backhanders. It was just impossible.
Wow.
But that was the environment at the time. And so, this socialism breeds a level of corruption which becomes endemic in the system. And very often we don't actually see it because we're so used to it, we don't think it's corruption. But that basically is what goes on. And this is this has sort of ended up with so much government disinformation, telling us what the government wants us to hear as a matter of course, rather than telling the truth. And so the whole thing gets we're now at the stage where this has got to the point where conspiracy theories arise basically because nobody believes what government tells them anymore. So, it's been an interesting journey over the last 50 years. I haven't sort of stuck just to the security side, for which I apologize, but it seems to me that we've seen an evolution in society which has been funded basically by debt, or put another way, by the magic money tree. And so here we are on the brink, if you like, of a recognition. I believe we are on the brink of a recognition that this is a problem and it cannot continue forever. And of course, once people recognize that, then the whole world changes.
So the fight continues, and we've got lots to do.
Yeah, well, I remember the statement, and you probably do too, Alastair, a statement from Margaret Thatcher, who said, socialism works until you run out of other people's money.
Yes, absolutely. It was a classic Maggie Thatcher. Yeah, absolutely.
Yeah.
Brilliant.
All right. Well, you've been in the industry for 5 decades. You need to be in there for another 5 just to keep getting the message out, Alastair. That's quite obvious.
I tell you what, I'll be very lucky if I last that long. And I think people would be rather bored with me by then anyway.
I personally think, Alastair, it's not going to take five decades for the stuff to hit the fan. So we're going to see some, I think so, really large action over the next 2, 3, 4 years.
I think so too. Which leads me to my first question that we have for you tonight. Going back a week ago, we interviewed David Morgan, and we determined that we have a major silver problem in this country, silver supply problem, in particular with the Perth Mint. And I'm not suggesting it's probably the case all around the world. In fact, the stories that keep coming back from other bullion dealerships would indicate the same. But I know that we have a problem here, in particular with our major supplier, the Perth Mint. Just to give you an indication, it's been 6 weeks since we were able to place an order on the Perth Mint for 1 kilo bars, 100-ounce bars, which are the 2 most popular sizes they have anywhere. Anyway, so haven't been able to place an order. Going back about a week ago, they introduced some kilo bars for about 30 minutes, and they ran out. It was a couple of 100 bars. They ran out. Okay, so what's the cause of this? They suggested at the time that they had another operation. They were concentrating mainly on silver coins, Alastair. So that prevented them from putting an emphasis on kilo 100-ounce denominated bars. I mentioned this to David, and he knew anyway, that the 2 operations are very distant from one another, and one would never affect the other. So it just made no sense at all that that would be a problem. We've had numerous clients contacting us and suggesting that they've got unallocated, pool allocated metal, and they've decided for various reasons to have physical metal or have the metal barred and take delivery of physical metal. On just about every occasion, or on every occasion from those that are speaking with us, they've been denied the opportunity of receiving their metal, and they've been asked to, or it's been suggested to them, they go on the queue with no time frame whatsoever of being able to deliver. In fact, we've got some people who've waited 2 weeks, asked to go back a fortnight later and ask the question again and see a repeat of the same answer. We don't know when we can supply. So going back a few days ago, just 3 or 4 days ago, the CEO of the Perth Mint, Richard Hayes, was interviewed on radio, and he said, look, there is absolutely no problem at all with silver supply. 1 day later, 24 hours later, they took kilo bars, 100 ounce bars, and all silver denominated bars, took them all off the website. And that's remained the same since. So you cannot, as I read it, if you go to the website, you cannot place an order at this point of time on silver bars of any denomination. Now, my question to you is, what on earth is going on? We're told by the CEO we have no problem with silver, and yet there is absolutely no way at the moment you can place an order on them. And we're still getting feedback from those that have unallocated and pool allocated product and cannot have it barred. I mean, are we out of silver? Is this just something that the Perth Mint is experiencing, or is it a global issue at the moment? Could you give us your thoughts on that?
The answer is it is basically a global issue. I think the easiest way to understand this is that basically in the, let's call it the wholesale market, there are two types of operator in terms of demand. You've got industrial demand and you have got investment demand. Now, the bulk of that investment demand is in the form of ETFs. And I mean, we saw in London, to sort of confirm that this is more of a global problem than an Australian problem. We saw in London that the silver ETF SLV made a statement that it might have to suspend share creation if physical silver was not available in sufficient amounts to the authorized participants. There was also another ETF run by Aberdeen Investment Management, which came out with a similar sort of statement. Clearly, I mean, when you look at the LBMA vaulting figures, I can't remember exactly what they say, but I mean, let's say that they say there's something like 18,000 tons vaulted. I mean, the idea that this is liquidity is something is being promoted by implication by the LBMA, but it's not liquidity. It is owned by a mixture of industrial interests and ETFs. Now, the industrialist interests, I mean, put yourself in the shoes of someone, let's say, making solar panels. And you have you need, let's say, let's just pick a figure out of the air, 100 tons of silver, every quarter, basically, to churn out these panels. Or you might be a manufacturer of socks, and it's extremely useful stuff in sort of very, very small particle form to kill the bacteria in socks, and so you sell socks. Anyway, whatever it is, you're a manufacturer. You have got a demand for silver. What do? You go and buy it in the market. Do you bring it into your warehouse and sort of stack it in a corner until such time as you need to draw down? No, you don't. You leave it vaulted. And this is why there is no liquidity in the London vaults, because on the one hand, you have got the industrial stuff sitting there waiting to be drawn down, and it's drawn out all the time, but against that, there's new mine stuff coming in all the time. And you have got the ETFs. And this was why when we had this extraordinary situation, with the sort of Robin Hood and Reddit, whatever, the guys there had spotted that there might be a liquidity problem in the silver market, and they were dead right. And it scared the pants off the establishment. Now, the establishment has a problem. Where they're really short is not on silver. They're really short on gold. Now, they've been managing that position down. As far as silver is concerned, this is rather like a canary in a gas field filled coal mine, because if silver really took off and that gold silver ratio started falling down towards 50, you can just see what would happen to demand for gold. It would just also take off, not at the same pace maybe, but the idea that the bullion banks would be able to close their positions in gold, forget it. They're still short, incidentally, in terms of value of about a net $21 billion spread between, I guess, about 30 bullion bank trading desks. So they've still got a problem there, and they don't, they want to resolve it. Again, put yourself in the shoes of a trader, or probably his boss in the bank. What he sees is he's got his trading desk has got a short position. He sees the Fed printing money like they've never done before. They see other central banks like the ECB doing exactly the same thing. Anyone with a sort of rational view on what's going on would be scared stiff of running a short position in gold or silver. It's actually as simple as that. So these guys are under the cosh to close their position for that very simple reason. This is not an environment where basically you rip off the hedge funds by, sucking them in and then banging the price, talking to Charlie in the pub. You work it together. Look, let's face it, there is collusion in this. Illegal collusion. And that game is over. But the problem is that the boys have got caught short. And this really came true a year ago this week, because on the Friday the 20th, Jay Powell turned around and cut interest rates, the Fed funds rate, down from 1.5% to 0. And that was Friday. On the Monday, the FOMC produced an emergency statement. We're going to do 120 billion of QE every month. And we're going to do this, we're going to do that. There are all these other things. We're going to ensure that the corporate bond market not only remains open, but remains open with reasonable interest rates. They were suppressing the whole thing. It was the equivalent of Mario Draghi's whatever it takes when the Spanish economic crisis occurred back in, I think, that was 2013 or something. Anyway, Jay Powell is doing exactly the same thing. Well, what happened to gold? They had been trying to get gold down, because you may remember that I think it was about January the 8th, it might have been January or February, the peak level of open interest on COMEX was just under 800,000 contracts. And of course, the people on the other side of the longs were the bullion banks. They were short up to their eyeballs.
Yeah.
They needed to get it down. So there was a coordinated attempt to rescue the market. That's what it was. We don't know the full extent of the operations behind the scenes, but I think it's entirely reasonable to suggest that the Bank of England was involved, arranging leasing to provide liquidity into the market. At the same time, the LBMA and COMEX got together to say that this is a temporary problem brought about by refiners and mines output being restricted because of COVID lockdowns. Remember that 3 of the big Swiss refiners are based in Ticino, which sort of near the Italian border, and that was the canton in Switzerland which really got worst affected by the initial COVID problem. So, there was this sort of huge attempt to try and rescue the market. The premium on COMEX went up to something like $90 over spot. during that process. And the price eventually went up. Price of gold eventually went up to 2070 or something. I think it was more or less the top. And then we find subsequently that GLD, the big gold ETF, had as a sub-custodian the Bank of England. Now, where did that gold come from? From memory, it was short 50 tons or something like that. Where did that come from? Well, it was quite clear. It could only be there because it had been leased to GLD, or rather an authorized participant who then delivered it to GLD. So we have a problem. And this is a problem which is going to arise, as Buffett said, when the tide goes out, you're going to see who's wearing the trousers or pants. But the problem that is really going to arise in this is that when we get a crisis, and it's when and not if, in the precious metals market, an awful lot of the gold, which people think they own, actually is owned by a central bank, and they do not have title to it. Because, I'll remind your viewers that the terms of a leasing contract is that ownership does not transfer. I mean, imagine you go down the road to hire a power tool. That's not your. You've got it. You've got the use of it for a week or whatever, but it's not your property. You have to return it to the hire shop. It's exactly the same with a gold lease. So we're looking at a crisis which actually started in the wake of Jay Powell's version of whatever it takes, and it's a continuing crisis. Having run up to that sort of over 2,000 price, the bullion banks have done a miraculous job of bringing the thing back under control. And a lot of that is the management of expectations. We are effectively told by a cadre of people like technical analysts, traders in the market, that gold has got further downside. You've got individual investors in ETFs looking at the way their gold is going down, particularly contrasting to the way Bitcoin is going up, and thinking, this is not working. I don't believe people like Alasdair Macleod anymore because obviously he's got it so wrong, and so on. Now, this is the psychology that the establishment wants us to fall for. And because, and I'm sure this will probably come out in a later question, because the fact of the matter is that gold is sound money, fiat money is unsound, but fiat money is the direct interest of every central bank.
Well, look, I see at the moment, and I've not seen this before to this extent, but I see panic in the market at the moment. Here in Australia, I see panic from clients that we speak with. They are just desperate to be able to place an order. Do you have it? Is that silver available? Can you guarantee us supply? I'm just wondering, how long can you continue to suppress prices when the demand is, we're talking law of supply and demand here. How long can you suppress prices when the demand is so high? Your thoughts on that? Because right now, the demand on us is massive because you can't get it. We're supplying metal at the moment, but generally speaking, it's really hard to come by. So how long can that continue before you just see massively escalating prices?
I would make certainly two comments. The first is that the market always wins. We don't know when it'll win, but it will win. And the idea that this situation can continue is fairyland. It's not going to continue. It will resolve itself. Now, that doesn't help you. It's not just you, but virtually everybody in the business has the same problem. Unless you've actually got stocks, GoldMoney, for example, they tend to run a stock position all the time. So, so do various other businesses. But having said that, it is a real problem. The second point I would make is that the three of us are effectively fighting City Hall. And now the good advice is don't fight City Hall. But that is not the advice that we're taking. We know that the City Hall actually has a problem. We know that the City Hall is stuffed full of people who are selling us a fairy tale, and that needs to be exposed. So as an economist, that's my interest. And I think, your very good friend, John Adams, has the same sort of approach. But I really think that the time when this is going to fall apart is going to happen fairly soon. Moving away from precious metals, let's just look at the economic situation. There is a parallel in my mind, and there's an extremely close parallel with what John Law did with the Mississippi bubble exactly 300 years ago. In 1720, so 301 years ago, that bubble imploded. Very briefly, what he did was he got control over the production of money, and he produced fiat money, and it was called the livre. It was the livre before he took it on, but basically he became the controller of the currency, and his bank was changed from Banque Générale, which is his own bank, into Banque Royale. Now, he still owned the bank, but the point behind it was that it had, it was now effectively a prototype central bank. He had another venture which he wanted to combine with the bank, and that is that he had a total monopoly on France's exports and imports. But he needed to raise money. And this is not just in the Mississippi. This is also, in the Far East and the Near East and Far East and the Indian interests and all the rest of it of the French state, of the king. Now, that monopoly required funding because he needed to build a fleet of ships to transport goods to and from wherever. So his scheme basically was to continue to puff up the value of the shares of the Mississippi venture. And he did that basically by offering, the sort of the French people who are lucky enough to get the offer, partly paired shares, which gave him gearing. So if, let us say, the shares of, and particularly the Royal Bank, went up by something like 10%, they made 100%. Now you can imagine that this was a speculative environment which turned into a bubble. But the problem with all bubbles is, you can blow and blow and blow, when it gets to a certain size, and you just keep on blowing, but it never seems to get any bigger, And he had the problem that all the earlier promises of, partly paid, next 6 months is the first payment sort of thing. Well, these payments were coming due. So people had to sell shares in order to make the payments. So you can see that this blowing in the bubble, John Law was beginning to run out of puff. And the whole thing, what happened was that the shares in the combined Mississippi venture peaked in around about January 1720 at about 12,000 livres. That's right, about 12,000 livres. By about September, the shares were down to about 3,000 livres. So you can see that this was a very, very nasty bear market.
Yeah.
But the currency fell from a value on the London and Amsterdam foreign exchange markets to zero. There was no quote in September for the French livre. So it was completely valueless. Now, that's the history lesson. Let's come back to today. What is the Fed doing? The Fed is doing exactly the same thing with QE. Because what QE is it's a pass-through through the banking system into the pension funds and into the insurance funds. So we've got 120 billion a month. And look how QE has had to grow in order to continue to puff up the market. Because what the pension funds and the insurance funds do is they sell government debt to the Fed, they get the cash, and they're encouraged to invest it in riskier assets. So they go in and they support the corporate bond market. They go in and they increase their allocation into equities. That's what's driving this bull market. People are sitting here saying, this is divorced from the fundamentals. Yeah, of course it is. It's got nothing to do with fundamentals. It's got to do with all the money that's being produced, John Law-like, by the Fed. But it's not just the Fed, it's the Bank of England, it is the ECB, and for all I know, and I don't know that this is the case, but it could well be the case in Australia. So we have this situation where we have got a global John Law experience. Now, the experience comes in two parts. There's that nice bit where we feel that we're getting wealthy because our share prices are going up. And then there's the second bit, which is considerably less nice. And that is that they go down because the balloon has burst.
Yes.
The lesson in all this is that the future of paper currencies is tied inextricably with the future of financial asset prices. One goes down, they both go down.
Yeah.
So this suggests to me that the fall in the purchasing power of fiat currencies is going to be very sudden, because when we get a bubble bursting, nowadays, remember in France, you didn't have the communications and all that sort of stuff. And when it came to payments, and things like that, you had to go to the local branch of the John Law Bank. There was one in Lyon, for example. You could go there. But, that was still probably a day's trip. You didn't get the information feeding back. So people didn't suddenly think, I better react to this event. No, they didn't hear about the event until whenever. So naturally, the time taken for a financial crisis today to fully resolve itself is considerably shorter than it was in those days. And the other thing about it, and this is why I don't think it's quite the same as the situation that we had in Germany in 1922, 1923, that was a different thing, because it didn't have the financial assets tied to the rapid expansion in the quantity of paper marks in circulation. That was more about financing government direct. I mean, there wasn't a mechanism whereby the government went into the market, bought bonds, raised money in the market through bonds, which was ended up with injecting money into the system, took some of the savings out of the system. So it wasn't that at all. It was just naked money printing as a form of revenue. And the difference between the John Law experience and that is that we were looking at a combination of the declining purchasing power purely from the point of view of the volumes of money being printed, and the declining purchasing power because people began to wake up to the fact that the governments were going to pursue this to the point where the money would be completely worthless. Now that hastened the speed in the last moments where they started dumping money. The stories about someone leaving a wheelbarrow of notes outside the shop, goes in to buy something and finds that someone's stolen the wheelbarrow and left all the notes on the pavement.
Right.
That was the sort of thing that happened after May 1923. This, to me, is a financial crisis rather than a loss of purchasing power through pure monetary inflation crisis. The effect, I think, is likely to be far more rapid as a result once the dominoes start falling than we might otherwise expect. I mean, you've got people talking about central banks are looking like introducing central bank digital currencies and all the rest of it. Yeah, I can see all that, but will they have time to do it? I think not. This crisis, I think, is very, very close to it. And tell me if I'm going on too much, but there is another aspect to this. I mean, I've mentioned the Fed. Have a look at the ECB, have a look at the Euro, have a look at the European Union. The banks, the commercial banks in the Eurozone are effectively bust. I mean, they've ended up being extremely highly geared. They have perhaps an average level of gearing at least twice that of the Americans. Their share prices are absolutely on the floor, so that it means that the gearing between the total assets in the bank's balance sheet and the market value of the equity in many cases is over 80 times. This is frightening. This is frightening. I mean, we're talking about shares that have rallied. And the way I put it in one of my last articles was, the banks, the Eurozone banks are rather like a bunch of drunks in a bull market trying to get out of the gutter and stand up, and that's what the share prices have done. I mean, no more than that. The fact that Deutsche Bank has doubled, BNP has doubled, Santander has doubled from the bottom of all this, is immaterial because they are still they're still, if you like, 1 foot in the gutter and likely to fall over. And the answer to this is that for some time now, local regulators have taken the non-performing loans in the banks and deemed them to be performing. Why? Because it takes it out of the commercial banking system. It takes it out of the sphere of the regulators. Because as soon as the loans are determined by the local regulator to be performing, they can be bundled up as collateral to do repos with the local national bank. So the bad debts then effectively go into the Target 2 system, which is the settlement system between all the national central banks and the ECB. Now, this is part of the reason why if you take the combination of the Spanish and Italian national central banks, they owe, and I'm going to strip out also the effect of the ECB, because the ECB deficit, if you like, lowers their apparent net deficit into the system. I reckon that Spain and Italy about 1.2, 1.3 trillion euros owed into the system. On the other end of this, you've got the Bundesbank, who are owed about 1.2 trillion euros. Now, we can see that this system, if you like, is rotten to the core. Now we have COVID lockdown 1, COVID lockdown 2, COVID lockdown 3. We have bankers who realize that they are in an impossible position. Are they going to lend more money to sufferers from COVID 1, COVID 2, and so on? The answer is no. You have got a huge wave of unrecognized bad debts in all the nations, but particularly in Greece, France, Italy, Spain, Portugal. And there is no doubt that these banks are going to fall over because of their gearing to all this massive, unexpected debt. So it's not just the Fed that has got itself into a pickle, but also the ECB and the Euro and the whole Eurozone is likely to face an existential collapse. So, don't ask me which one's going to happen first. And I mean, I could make similar comments about other nations. I mean, if you look at the Chinese banks, just purely in terms of their market rating is actually quite similar to the Eurozone GSIB banks. Now, the difference there in China is that the Chinese government stands behind the banks very definitely. I mean, they don't have to rescue the banks; they just need to put money into them. But in anywhere else, where the banks are meant to be sort of independent, as it were, you got shareholders, and they go. When they collapse, yes, they will be rescued, but it's. How do you do it when we've got such an obvious domino situation building up for different reasons in different jurisdictions? Yes. I mean, the American banking system is geared roughly 10.5 times if you look at the GSIBs. Now, that is rich in terms of the bank credit cycle. At the bottom of the bank credit cycle, you'd expect that to go to about, sort of maybe 4, 5, 6 times, something like that. So 10.5 is rich, but it's not in itself a huge, great problem. But, put yourself in the shoes of the banker. For every $1 you lose on your balance sheet, it's magnified 10 times at the equity level. So, they're not in a comfortable position at all. And the whole system is very, very fragile.
Alastair, that is a a fantastic speech and
very complete answer.
Very complete answer. No, but I will stop you there because you'll answer my next question if we keep on going. Because it is based on, the question is based on world debt, all right? So it's right up this alley, and let's continue. So basically what I've got down here, I'm just going to, a couple of figures, and then I'm going to make a statement, and then we want some more information from you. I want to talk about the world debt. If we go to the website usdebtclock.org, we will see that the US government has a present debt of approximately, debt of approximately 28 trillion US dollars. If you look further in other countries' debt, it becomes a minefield of numbers, with Australia debt of around 1.7 trillion. Japan and Europe are even worse after looking at their GDP. I want to go to, and this is what I do with all of our clients, the ones that I deal with. I'm sure Darryl does similar things, but this is how I present the value or where this is all going. So we're going to start with the creation of the US Federal Reserve in 1913, when the Federal Reserve opens its doors. So how I explain this debt level is like this. If I take a client down let's go back 100 years or so, and it's 1913, we knock on the door of the Federal Reserve the day it opens, right? They've been planning it from 1910, but 1913 is when it opened. So we're going to knock on the door of the Federal Reserve, 1910, and we're going to borrow the first US $1 bill. Now we've got to remember at this stage, nobody else has a US dollar bill. We're going to borrow the first one, right? So my question is always to the client, if you borrow the first one and nobody else has one, how do you pay the interest? And I let the person think about it for a second, maybe 30 seconds, and I've never yet had one person, in my opinion, answer it accurately. But I always say that's all right because nobody's ever asked you that question before. But the answer is you have to borrow another one. So it doesn't matter whether you borrow the first $1, the first $10. Now, by the way, $1 was a week's worth of groceries back then. $10, $50, $100, $1,000, $1,000,000. You always have to borrow more to pay back the interest on what's already been in existence. So, moving forward, after President Reagan came to power, every 8 years after, the US government deficit doubles. Obama took the reins at around 8 to 9 trillion deficit and finished at 18 trillion. And of course, Mr. President Trump, as much as I liked him, he still was a big spender. Trump took over from 2016, finished in 2020, and finished with a deficit of 28 trillion. Alastair, how far before it explodes?
I think, Brian, we must be close to it. Let me sort of rewind your take on it. Before the Fed came along, and more or less about the same time, certainly before the start of the 20th century, there was a cycle of bank credit. Now, it wasn't a business cycle. It's always a mistake that Keynesians make. They think it's a business cycle. It's not. It's actually a cycle which has its origins in the expansion and contraction of bank credit. The crises that we saw in the 19th century, particularly after the 1844 Bank Charter Act, or Peel's Banking Act, that sometimes referred to, was that banks, instead of sort of producing money against their reserves and all the rest of it, they ended up going into more risky ventures. And so you had the Over-End Gurney collapse. Now, the Over-End Gurney bank was actually just a simple deposit bank, which just ventured into areas it just didn't understand. And then you had the Barings collapse. Now, that was financing things abroad, which they didn't understand, particularly in South America. There is this sort of cycle of human psychology, whereby you start off being pretty cautious in what you're doing. You have some success, and it encourages you to take slightly greater risks because you know you know how to make money. You've established yourself how you have made money. So your bank, this the point about the 1844 Bank Charter Act is that it allowed banks to expand their balance sheets beyond their deposits. It allowed them to create money out of thin air, to run on a fractional reserve basis. So, you're this banker, you've sort of, you've started off in this cycle and you have proved that you know how to make money. You have the ability to expand your balance sheet beyond your capital. So what do? You increase your balance sheet relative to your capital. And instead of having 1-to-1, you're sort of having 2-to-1, 3-to-1, 4-to-1, perhaps. And, at sort of these levels, what you're sort of slightly torn because you can see that the economy is actually doing damn well. You've got to continue lending into this, but interest rates start rising. And then you start finding that some of your customers who did their business calculations on the basis that they were borrowing at 3%, find that now that they're forced to borrow at 5%, they can no longer make money. So they start withdrawing what they're doing. And this creates problems for their suppliers and all the rest of it. So you can see that at some stage, this expansion ends. And it ends because interest rates rise through pure demand and all this excess credit that is being lent out. And what happens? You then get a banking crisis because the thing starts going into reverse. I think it was Walter Bagehot who described the role of the Bank of England, and this was in the wake of the Baring crisis. The Bank of England didn't get involved other than facilitating other banks to come round and stop the thing from degenerating into a complete crisis. But the Bank of England basically was hands off. And it was Walter Bagehot who turned around and said that the Bank of England should act as the lender of last resort. So, then you get the creation of the Fed some 20, 30 years later. And Benjamin Strong, who basically was an inflationist, he believed in pushing money into the economy because bankers had learned by then that if you expand your balance sheet, you are helping economic activity. Without thinking through the consequences on the other side. So you can see that, from a government point of view, you had an absolute depression in 2021, which lasted 18 months and was extremely deep. But it only lasted so long because government took the view, we got to stand back from this, let the market sort it out. That was the last time that happened. The next time was after the Roaring Twenties. And, we have this idea of the Roaring Twenties of being partying and everybody making money and, most of the motor industry and, household appliances and the mechanization of agriculture, which actually was driving down prices at that stage. We have all those sort of wonderful images of everything expanding and so on, but it was all on the back of credit. And inevitably, 1929 comes along. It reaches a tipping point in late September, early October 1929. And that led to a collapse of the market whereby the Dow Jones lost 90% of its index value between that peak in 1929 and the bottom in mid 1932. So this is a cycle. Now, increasingly, the central banks have decided that they need to try and tame this cycle. They look at it as a business cycle, incidentally. And the whole point about macroeconomics, the production of statistics, which was really advanced in the 1930s, Keynes's work, particularly his general theory, which was published in 1936, was to give government a role in the free market, because the free market, as far as these guys were concerned, had demonstrated that it could not manage itself. So they needed government intervention to help it from time to time. So Keynes recommended, quite simply, that when you have a recession or depression, government should run a deficit in order to inject money into the economy to help it recover. So this was the sort of start of the intervention thing. But the fallacy in all this is only now, really, in the 21st century, becoming more obvious to growing numbers of us. We have the accumulation of debt, because the whole point about government rescue is that what it will do is it'll look at those industries which it believes should be supported. And inevitably, those are the labor-intensive ones. Those are the ones that have been around for some time, and government understands, produces things that either the government wants or consumers want. But what government doesn't understand is that these businesses have become zombies. And they've started trying to control the whole thing. They will lobby the politicians and say, well, if you give us some money, we'll be able to build a factory in your constituency. I'm putting it very crudely, but that basically is the story. The whole point about Brussels is it's one huge, great lobbying industry. Lobbying is a very polite term for crony business. And so you end up with business going into the business of protectionism rather than producing things that consumers really want. So, all these factors are coming together. Debt, if you like, is the quantitative marker of where this has gone, but, it's only part of the story. And we get to the stage where the whole thing just cannot, this merry-go-round cannot continue to go on. And that, in my view, is roughly where we are. And this is why I bring up the John Law situation, because that very much is the final act, if you like, in a long-term evolution of events whereby the establishment thinks it's got control over the markets. The better way to look at debt, government debt, is to look at the relation between government debt and the private sector, GDP. Because to include government GDP in your GDP estimate, so if you look at a country like France, for example, France has a government debt to GDP of around about 130%. But less than half of the economy is private sector. This is important because it's the private sector that provides the tax revenues, which gives the markets confidence that the French government can finance its debt. So actually, it's not 130%, it's 260%. The figure for Italy is debt to GDP is about 170%. So there we're looking at 340. No, in fact, it's worse. It's a bit worse than that, because I think the other thing you don't know is how much of private sector GDP is actually off balance sheet government. Greece is 200% debt to GDP.
It's unfathomable.
Anyway, so we can see, I think another point I would make is that just looking at statistics and assuming that statistics, and this is what drives the market moment to moment. The idea that you get a 0.1% variation in what the market thought the statistic would be and stocks go shooting up or they go shooting up, it's complete nonsense. We're looking at a far, far more important situation where, individual statistics or the accuracy of statistics, forget the accuracy of statistics. Lord Canning, who was Prime Minister back in 1820, when statistics were perhaps less of a science than they are today, said he could prove anything with statistics except the truth. And that is something that we should really keep it firmly fixed in our minds today.
Look, before Darryl sort of finishes off on this interview, and I was talking to David Morgan last week or so, and I brought this subject up, and we were talking about debt, inflation, and everything else. I live in Prospect in Adelaide, and the bottom line here is that we live about 12 minutes from the CBD, so it's very close to the city, right? Unfortunately, a family member passed away next door to us, and the house and land was sold. Now, I don't mind telling these figures. It sold around about $600,000. But anyway, just a month ago, a house across the road was also sold, but it's really land value. The house was not much, right? And this sold for $800,000, $200,000 more in a period of about 18 months, right? And we can see this in Adelaide and in Melbourne and Sydney happening right now. that these land and house prices are just going up by skyrockets. And what you've just said in this particular interview is that you've just said exactly what's going on. The amount of money pouring into the market. Darryl?
Yeah, I'll never forget the words of Vern Gowdy, who wrote the book The End of Australia. And Vern said, I've never known of any other way of going broke but to have too much debt. Yeah, and people come up with all sorts of theories, but it's too much debt. And that's exactly where we're heading right now. Well, we're more than heading there. We're really in the thick of it.
Yeah.
Alastair, if somebody wanted to, and we've got lots of viewers and subscribers, of course, that I'm sure would love to connect with more of your work, where would they go to do that? What would you recommend?
Well, I write a weekly article for GoldMoney. So if you go to goldmoney.com and hit the research tab, you'll find that under that there's another menu, and my articles appear under Insights. So, and they're published on Thursday afternoon Eastern Standard Time, which is probably, so you probably wake up on the Friday morning and have it and have access to it. And I also do a market report, which again is on that research tab, and it's market reports, whatever. And that I do on Friday, and that again is published in the early afternoon or Eastern Standard Time in the US. So those are the two things I do regularly. I also, as you mentioned earlier, I do appear on a number of sort of websites and interviews and so on and so forth. And I think if you follow me on Twitter, which is at Macleod Finance, you'll probably pick up access to those, via my Twitter, because when I'm aware that they're released, I then tweet them, or retweet them. So that's probably the best way to keep in touch with what I'm saying. But you'll probably find that a lot of it is repetitious, but hopefully it is educational. And because my intention really is to help people understand what is going on. I'm not necessarily an out-and-out advocate of monetary metals. I'm just quite simply an advocate of sound money and explaining why sound money is so important. It just so happens that sound money, the only form of sound money which we can take out of government's control, is metallic money, which is gold, silver, and copper.
Look, what was it? I think I can remember the quote that repetition is the mother of all learning. So to hear it over and over and over again. And that's what's led Brian and myself to take an interest in precious metals in the first place, because we heard it over and over and over again from my lifetime mentor, Peter Daniel Sr., of course.
Exactly.
Yeah.
Alastair, on that same thing, there's a book that I love. People have heard me recommend it before, but it's a book called The Creature from Jekyll Island. I'm sure you've heard of it. I'm in my fifth reading at the moment. So, every time I pick up that book and I say, I can't remember reading that before. So it's just information that's repetitive, but it's sunk through eventually. And that's what I talk about. Darryl?
Yeah, look, I think more than ever, and we keep saying this, and I'm sure Alastair would agree, Jim Sinclair, become your own central bank. I think more than ever that becomes such an important issue. If central banks think it represents value, holding physical metal in their vaults, then surely it represents value for us to do the same.
Yeah.
So, once again, I know there are some people who get involved in the precious metals industry to make money overnight, as they might with a Bitcoin and cryptocurrency. But hey, Brian and I have been investing in precious metals now for over 30 years. I can remember when we purchased silver, Brian, in 2000 for around $6 an ounce, and it's a lot more than that today. And I remember when we purchased gold at just under 300, and it's a lot more than that today. Now, you've only got to do your sums on that, and if you're a consistent saver in precious metals, you're not going to have any issues no matter how bad the storm is ahead. But I do agree with Alastair about being able to contribute place yourself in a good financial position. And that's what you need to do. You've really got to be in a good, sound financial position yourself before you can help anybody else. You agree with that, Alastair?
Yes, I agree with that wholeheartedly. And I'd also make another comment, and that is there is a huge difference between investment, which is the way most people are looking at it. I mean, they'll be thinking in terms of, I've paid X in Australian dollars for my gold, and it may even be an ETF, or it might be through, ownership of GoldMoney or something like that, where the objective is to continue to have it valued in Australian dollars and eventually to sell that investment for Australian dollars. Yeah. That ignores the fact that Australian dollars are losing purchasing power.
Yeah, exactly.
What we're talking about is the physical possession or the lodgement of gold and silver, physical gold and silver, with a trusted source outside the banking system, which you can access at a future date to do what? Yeah. To spend it. That is the key. The key difference between what we're doing is we're hoarding metallic money against a crisis. And look at it as an insurance policy, if you like.
Yes.
And that is a fundamentally different function from investing. So, if you're an investor, you worry about, here we are seeing gold having fallen from over $2,000. It's now standing at, $1,700 or something, and oh my God, I'm losing money. That is not the point. It's very difficult to get this over, actually. It really is difficult because people genuinely find it very difficult to think outside that, I'm making an investment. I've got some gold, I've got some shares, I've got some bonds, I've got some whatever it is. I've got a house and so on, and I've got another house. This is different. This is very, very different. We're not talking that game at all. We are talking about ensuring that you will continue to survive through a coming maelstrom, a financial maelstrom, which is likely to lead, almost certainly, in my view, to lead to a complete collapse in purchasing power of fiat currencies. Yes. Then what have you got? To give you a comparison, this is one I have repeated before, but if you go back to Germany in early 1923, you could have bought a 6-bedroom house in a swanky part of Berlin for $100. $100 at that time represented just less than 5 ounces of gold because it was convertible at the holder's option at the rate of $20.67 to the ounce. Yes. So, you think investing in property, that'll give you some protection, but that's what happens to property in a complete currency collapse.
Yes.
Yeah.
Unbelievable.
Point about it is the middle classes, and this will be the bulk of your viewership, the middle classes are wiped out in that situation. They're wiped out. They are impoverished in a currency collapse. And that's why it is desperately important for anyone with savings to just put a little bit aside into gold and silver, the amount they determine. And, Macleod might be talking absolute rubbish, or they might think I have something. Make your own decision, but don't ignore it. That is the important point.
Thank you.
Wow.
Yes, I agree. Thank you so much for your input this evening, Alastair. It's I'm sure it'll be beautifully received, and we look forward to many more of these interviews with you over the next year. And we, of course, would love to think that you'll be on board with us at a couple of at least two major events over the next 12 months. So we're looking forward to all of that. Thank you for your contribution this evening. Very much appreciated, beautifully researched, and we look forward to many more in the future. To all of our subscribers, our viewers, we thank them so much for constantly and continuing to support this channel. And so until next time, can I just say, stay well, stay focused, and goodbye for now.
Goodbye for now.